It's been a big week for the world of financial markets. The main highlight for Australian businesses from Tuesday was expected to be the federal budget. But in the end, the RBA trumped Scott Morrison with its 0.25% cut to the official cash rate, which will be beneficial to consumer and retail activity, and therefore also to small businesses. The rationale for the cut was primarily the fall in core inflation and the CPI, as we outlined last week. But reading the RBA comments, you also get a sense that the level of the exchange rate was a factor, partly because a lower exchange rate can lift inflation, and also with the success APRA has had in reining in property investor lending, meaning this latest cut could be delivered with less risk of exacerbating the property market. With zero to negative interest rates common overseas, the RBA has a challenging task in balancing inflation, growth and currency levels without creating structural imbalances. The federal budget was also good news for small business, with a lower tax rate extended from 28.5% down to 27.5%, and businesses qualifying for this corporate tax cut extended from last year's $2 million turnover limit now to $10 million. This larger group of businesses enjoying tax cuts can also participate in equipment financing concessions, with immediate deduction of the depreciation for assets of up to $20,000 in value. Over the next decade, the size of businesses benefiting from lower corporate tax rates will gradually increase, eventually applying to all businesses. Importantly, while debt levels have risen a little via the budget, the net government debt to GDP ratio still only peaks at around 19.2%, which should keep the ratings agencies happy and our AAA credit ratings secure. A budget surplus won't be seen again until 2020 at the soonest. But at these borrowing rates, with 10-year government bonds trading around 2.5%, maybe this isn't such a bad thing. Meanwhile, overseas, the message remains the same: slowing growth and far too much debt, which again makes our 3% growth rate and under 20% debt to GDP look pretty good. No wonder the RBA needs to keep talking and pushing our interest rates down to avoid the Aussie dollar going back above 80 cents and risking economic transition post the resources boom. And finally, local trade data and retail sales figures hot off the press were encouraging, with retail sales up 0.4% month on month, helping to stabilise the Aussie dollar near 75 cents after all its trials and tribulations over the week. Having peaked above 78 cents, the RBA will be happy it is now over 3 cents lower, although their battle to keep it at bay will be an ongoing one. Until next week, that's the market update from Bendigo Bank.